I often hear comments such as, "I don't understand pensions," or "pensions are rubbish, they aren't worth saving into." The thing is, whilst there are complexities surrounding pensions at a headline level, they are actually a relatively straightforward product to understand. Let's start with the different types of pension. What often causes confusion is the many different names of pensions and what they mean. So it's probably best to start with the first distinction: workplace pensions and personal pensions. A workplace pension, as the title suggests, is provided by your employer, whereas a personal pension is one that you may set up yourself. If we focus on workplace pensions initially, there are two main types: defined benefit and defined contribution. Defined benefit, or DB pensions, are often referred to as final salary pensions, or perhaps even career average revalued earnings pensions. The acronym for this is CARE. A defined benefit pension is a promise of a guaranteed future income when you retire. They offer a known or defined future benefit, hence the name defined benefit pension. The level of this guaranteed income will be based on your earnings whilst employed with the company, the length of time you are with the employer, and a calculation known as an accrual rate, which is specific to the scheme you are in. If you work for the public sector, such as the police, fire service, NHS, civil service, teachers or armed forces, then you are most likely in a defined benefit pension scheme. You may also have a defined benefit pension if you've worked for a big employer for a long time. As they offer a guaranteed future income, they are a very valuable type of pension, which is why nowadays there aren't actually many of these types of schemes available anymore unless you work in the public sector. The second main type of pension is a defined contribution pension. This type of pension involves you building up a pot of money by making contributions from your salary that are invested over the years. The amount that you'll end up with when you retire is unknown. It depends on the contributions you make and the investment returns you receive over the years. The thing that is known or defined is the amount of contributions that you make, hence the name, defined contribution pension. So that's the two types of workplace pension. Personal pensions are always defined contribution pensions, so their future value is based on how much you put in and how they grow over time. What can be confusing is that despite these being the two main types of pension, there are lots of different names given to pensions, such as SIPs, stakeholder pensions, money purchase pensions, private pensions, group personal pensions. And whilst there are differences between all of these examples, they are actually referring to defined contribution pensions. So why are pensions the go-to product for saving for your retirement? Well, it's because they offer free money to you, the saver. This free money is known as tax relief. Tax relief works on the basis of rather than you paying income tax, it gets added to your pension instead. The government gives you your tax back as an incentive to save for retirement. Pretty cool, right? How this works in practice can differ depending on how your pension scheme is set up. For example, many, not all, but many workplace pensions will take your contribution into your pension from your salary before your income tax is deducted. So if you were making a £100 contribution into your pension, the full £100 would be invested into your pension. However, if this £100 hadn't been paid into your pension, then you would have had to pay income tax on it before it reached your bank account. If you're a basic rate taxpayer, then 20% income tax would be deducted, so you actually only receive £80. If you're a higher rate taxpayer, then 40% income tax would be deducted, so you only receive £60 into your bank account. So, whilst it's exactly the same £100, it's just if you pay it into your pension, you keep all of it, whereas if you take it as pay, then you only receive part of it because the income tax is deducted. The other huge benefit of a workplace pension is that you will also receive contributions from your employer. They'll often match your contribution up to a certain amount. So if you're a basic rate taxpayer and you put £100 into your pension, it is only costing you £80 due to the tax relief. And on top of this, if the employer matches it and puts £100 in too, then you end up with £200 in your pension, despite it only costing you £80. No other product will provide you with this type of growth on your money automatically. Pensions are such amazing products, yet due to people not understanding them properly, you can still hear people calling them rubbish. When making contributions into a personal pension, whilst the outcome is the same, the way the tax release is obtained is slightly different. For these types of pension, you pay £80 into your pension and the pension provider claims the basic rate tax relief from the government on your behalf. So whilst £80 left your bank account to be paid into your pension, you would actually see £100 invested on your pension statement. If you are a high rate taxpayer, you can claim an additional 20% tax back on top of this too when you do your tax return. So even though you put £100 into your pension, if you're a high rate taxpayer, it actually only costs you £60. Free money. The other fantastic feature of a pension is your money grows tax-free over the many years it is invested in there. This can help your money grow quicker as no tax is being taken off as your funds grow. I hear you saying, surely pensions suffer tax at some point? Well, yes, they are taxed eventually, but only at the point which you take your money out. So, how does your money grow in a pension? Again, this will depend on the type of pension you have. If I start with a defined benefit pension, with this type of pension, you and your employer make contributions. However, you aren't building a pot of money. Instead, you are increasing the amount of guaranteed income you will receive in your future retirement years. Think of this as the annual pension you will receive in retirement. This is where the accrual rate comes in that I briefly mentioned at the start of the video. For every year that you're an active contributing member of the scheme, you will increase the amount of annual pension that you are accumulating for the future. The other great feature of these types of pension is that any annual pension you have already built up from previous years will rise in line with an inflationary measure set by your scheme to help protect the future purchasing power of this money. This is known as indexation. This continues for each year you remain an active member of the scheme. If you leave the employer, then you will no longer be contributing into the pension, so you won't be accruing any more annual pension. You will now be called a deferred member of the scheme. However, any benefits you have already accrued whilst a member will continue to be indexed up by the inflationary increase each year. Growth of a defined contribution pension works differently. Any contributions made into the pension, whether those be personal contributions or employer contributions, are added to your pension fund, a pot of money that belongs to you. This money is invested. It is used to buy assets such as shares and bonds, which should grow over time. How big this pot of money gets is down to how much you pay in and how well the investments perform. So let me finish off with how money can be taken out of a pension. In a defined benefit pension, as I've already explained, you'll have built up a guaranteed income that you'll begin to start receiving from the retirement age of the scheme. It works in a very similar way to how your salary is paid. You'll get it into your bank account every month, for example, and you'll even receive a payslip and a P60 at the end of the tax year. And yes, this is the point that income tax will be due on the payments made to you. When your pension starts to be paid, you will usually see it increase each year. This is the indexation that continues to be applied even when the pension is in payment. A great feature of defined benefit pensions. If you take your pension earlier than the scheme retirement age, then your annual pension will be reduced, as the scheme is having to start making payments to you sooner than planned. Conversely, if you delay taking your pension until after the age of the scheme retirement, you may get an increased annual pension. If you're married and die before your spouse, then usually the scheme will provide a reduced annual pension to your spouse for the rest of their life. You could also choose to give up some of your guaranteed income in return for a tax-free lump sum paid when you start accessing your pension. The calculation of this is known as commutation. Each scheme will have different rules for this, so it's definitely worth understanding what they are for your scheme. With a defined contribution pension, you end up with a pot of money, and it is down to you to decide what to do with this pot of money when you reach retirement age. The retirement age for defined contribution pensions is currently 55, but this is rising to age 57 in 2028, when it will be linked to 10 years below your state pension age. So for example, if the state pension age increased to 68, then the minimum age you could access your defined contribution pension would be 58, 10 years below this. You can take up to 25% of your defined contribution pension as a tax-free lump sum. So if your pension pot was valued at £400,000, then you could take £100,000 of this as a tax-free lump sum. With the other 75% of your pot, you may have a variety of options, such as purchasing an annuity. This involves handing over the money that you've built up to an insurance company in exchange for a guaranteed income. This will be similar to a defined benefit pension. These are taxed just like your salary would be for your job. Another option is keeping the 75% invested, then drawing an income from it. You could take this as a monthly amount or at a different frequency. You could alter the level of income to suit your circumstances. This is known as drawdown. Any income taken in this way is taxable. Remember, with this option, your money is still invested. So you need to manage this wisely and consider how much you are drawing, as it is possible to run out of money one day. The benefit though is, it does provide flexibility as to how you're accessing your money. There are other ways to access your money from a pension, of course, and there is plenty of additional details on pensions that I've not covered in this video, but I hope it has helped you to understand them better and also to see why I believe pensions are such a great product.